Welcome to Chapter 1, Annuity Basics. Let's explore the fundamental concepts of annuities. These annuities are a mathematical concept where a lump sum of money is paid out in equal installments over time until the fund is exhausted. This vehicle helps liquidate a sum of money, with the remaining amount earning interest. Life insurance companies can guarantee income for the life of the annuitant due to their experience with mortality and survivorship factors. An example of an annuity is the 30-year lottery payout. So, an annuity is just a savings vehicle. It provides tax-deferred growth and guaranteed income for the life of the annuitant. There are two distinct time periods in an annuity. The accumulation period is the time from the first deposit to the selection of a settlement option. The annuity period, or distribution period, starts with the first periodic payment and continues for the life of the annuitant. These annuities are flexible and can be classified based on four characteristics: funding method, date the annuity benefit payments begin, payout period, and investment configuration. The first characteristic is how does the money go into the annuity. The name of the annuity will be either single premium or flexible premium. Funding methods for annuities include single premium, which is a lump sum, or a series of periodic premiums, which can be fixed or flexible. The second characteristic is when does the money start coming out of the annuity. Annuity benefit payments can begin immediately, within less than 12 months, or be deferred starting after more than 12 months. With a flexible premium deferred annuity, how does the money go into the annuity? Flexible payments. When does the money come out of the annuity? More than a year, or maybe never. The annuitant is not required to annuitize the annuity. With a single premium, immediate annuity, how does the money go into the annuity? Lump sum. When does the money come out of the annuity? Less than a year. With a single premium deferred annuity, how does the money go into the annuity? Lump sum. When does the money come out of the annuity? More than a year. What is the answer to this question? A lump sum of money is placed into an account from which the annuitant will draw periodic benefits beginning more than a year from the date of purchase. This describes a single premium deferred annuity. Chapter 2, Annuity Settlement Options. Let's delve into the various payout options available. The third characteristic that we use to identify the type of annuity is which lifetime payout option did the annuitant choose. There are 4 lifetime payout options. All 4 provide lifetime income to the annuitant. In order to know which option the question is asking about, we must look at what happens for the beneficiary, not the annuitant. Lifetime payout options include straight life, life with a refund, life with a period certain, and joint and survivor. The first option is life income, or straight life. This option provides income payable to the annuitant for life. But what happens for the beneficiary? There is no beneficiary. The trade-off, though, is that this option provides the highest monthly income. The second option is life income with refund. This option provides income payable to the annuitant for life. But what happens for the beneficiary? Here, the beneficiary receives a refund of what is left. The beneficiary receives the starting amount of the annuity, less any payments paid to the annuitant. The third option is life income with a period certain. This option provides income payable to the annuitant for life. But what happens for the beneficiary? Here, the beneficiary receives the remainder of the selected period. If death occurs during the period certain, the payments are made to the beneficiary until the end of the selected period. The fourth option is life income joint and survivor. What happens for the beneficiary? The beneficiary receives income for life. To review, what happens for the beneficiary? With straight life, the beneficiary gets nothing. With life with a refund, the beneficiary gets a refund of what's left over. With life with a period certain, the beneficiary gets the remainder of a guaranteed period of time. And with joint and survivor, the beneficiary gets income for life. What is the answer to this question? What annuity payout option provides for lifetime payments to the annuitant but guarantees a certain minimum term of payments, whether or not the annuitant is living? Life with a period certain. Chapter 3, Fixed Annuities. Let's explore the specifics of fixed annuities. The fourth characteristic is the underlying investment configuration. If it is a fixed annuity, the money is in the general account. If it is in a variable annuity, it is in the separate account. Just the same as with variable insurance policies, V. Variable means dual license, dual regulation. An indexed annuity is a type of fixed annuity, so the money is in the general account. Indexed annuities and indexed universal life policies, IUL, do not require securities licenses and offer greater gains than fixed annuities with more security than variable annuities. Key terms include participation rates, spreads, caps, floors, ratcheting, and point-to-point. Fixed annuities provide guaranteed interest rates and voluntary excess interest. However, they come with surrender charges and penalties for early withdrawal before age 59 and a half. They offer guaranteed fixed benefits but no inflation protection. Variable annuities are the focus of Chapter 4. These annuities offer different benefits and risks compared to fixed and indexed annuities. Variable annuities allow for tax-deferred accumulation and require taxes to be paid upon annuitization. They also have surrender charges and penalties for early withdrawal before age 59 and a half, but provide benefit payments over time. In variable annuities, values are expressed in units. Units are like shares. Accumulation units are based on the market value at the time of purchase. Florida law requires a report be provided at least once per year. The number of annuity units, once they are issued, remain the same, but their value can vary monthly, providing a hedge against inflation. Fixed and variable annuities protect against the risk of outliving your savings, unlike life insurance which protects against dying too soon, while fixed annuities offer interest rate guarantees. They may not keep up with inflation. Variable annuities were developed to mitigate this purchasing power risk. Regulation and licensing of annuities involve dual regulation by the Department of Insurance and the SEC. Agents need dual licensing, and a prospectus must be provided to potential clients containing detailed investment information. Thank you for taking the time to learn about annuities.